Great. Thanks, Neil. Yeah, appreciate everyone joining us today. Hopefully you're able to enjoy your lunch. And, I know just from the registration list, there's certainly lots of familiar people out there who I know and who know us, but there's also a lot of people who aren't familiar with StoneCastle. So what I'm going to talk about today is a few different things. First off, really what we do at StoneCastle that makes us different. And then we're quite excited about what we're seeing right now in the current market. And these conditions have really adopted and adapted and changed this year, where we came into the year very strong from an overall market perspective. And then things started to change as the year progressed. And then it became very narrow. We're starting to see that broaden out again. And typically when that happens, it means very strong returns for investors. And we thought it'd be worthwhile going over some of that. So just a bit of background on StoneCastle. We manage 4 different funds. We manage 2 funds for purpose investments out of Toronto, which are the Purpose Canadian Income Growth and the Purpose Canadian Equity Growth. Obviously, the difference between those two is the income fund pays a regular monthly dividend, and the growth fund is obviously looking for capital appreciation. We manage the StoneCastle Cannabis Growth Fund for our partner Spartan Investments out of Toronto. And then we have our own fund, which is the StoneCastle Fund. That one's not available through advisors. It's available only to individual investors. And it's available in BC, Ontario, Alberta, and Saskatchewan. As far as our performance goes, we have, we're really proud of our long-term track record. You can see, going out to inception of the portfolios, how well we've performed and how we've outperformed our benchmarks with the growth fund. And we're, right in line with everything on the income fund. And obviously we pay out an income with that fund as well. So when we talk about our process, we talk about it being definable, repeatable, and predictable. So definable in that we have criteria for why we're on offense, neutral, or defense. We also have criteria for why a company goes into our portfolio, but also why it comes out. Repeatable in that we could take the data today, we could take the data from 5 years ago or 5 years into the future, and we end up with a very similar portfolio. And then predictable in that we can't generate predictable returns because that's not possible with the markets. Obviously, human emotion comes into play. But what we can do is we can generate predictable attributes to our portfolio, and those attributes we know will drive long-term returns. Not every single, calendar month of the year, but over the long term, we know that we'll outperform. And as you can see from our numbers, that certainly is the case. So where do we start? We talk about being on our top-down process. We talk about being on offense, in neutral, or defense. And so what we're trying to figure out at any point in time is how our portfolio should be positioned. If we're on offense, we're fully invested. If we're in neutral, we're less than fully invested. We typically will raise cash. And if we're on defense, we raise significant amounts of cash. The question we often get asked is, if you're in neutral or defense, how much cash can you have? Well, it's not constrained by anything, as far as our investment restrictions go. So we could actually have 100% cash in the portfolio. We would effectively never be in that position because we always see opportunities out there, but we'll very routinely be 40 to 50% cash in the portfolio when we're in neutral or on defense. Now, how do we get there? We look at a number of different things. We look at some top-down economic indicators, and we're really looking at rate of change and rate of growth with those economic indicators. Because what we want to figure out is, if we're headed for a recession, that typically is when a bear market is going to come into play. So it's not once the recession's announced, it's when the market starts to anticipate that recession is going to come. And so we look at a number of different factors and different indicators from the market economic standpoint, and then we do as well from the market technical standpoint. So we're tracking a lot of under the surface indicators to see how strong the market is, what sectors are moving. And so how do we break that down? We rank and we have a sense with our sectors at any given time, which sectors are starting to gain relative strength, which are starting to lose relative strength. And we look at that from a top-down perspective. So we know, if technology has more relative strength than, say energy, or if, utilities has more relative strength than financials. And that helps us to identify what sectors we should be looking at and where we should be invested. At the same time, we're looking at the bottom-up process. So what we're looking for is we're looking for companies that have some sort of catalyst in their business today or in the future that's going to affect their earnings profile. And what we ideally want to see is accelerated earnings. Why do we want to see that? Because we know that if we have accelerated earnings, then there's really two ways for us to make money on the stock price. And at the end of the day, that's what it's all about, making money on the stock price. The first is as the earnings and the stock price track each other. So the higher the earnings go, the higher the stock price should go if it follows suit. The second is with those accelerated earnings, quite often what we find is that investors are willing to pay up for those earnings. And the more investors discover the accelerated earnings, the higher the multiple goes. So we make money on the multiple expansion as well. So the earnings growing up and the multiple expansion. In addition to that, with our income portfolio, we're obviously we look at income growth and the growth of that income, the dividend that the company's paying, and we look for beta. So we're trying to figure out whether or not the market has a higher or lower beta than that individual security that we have. Doesn't mean that every single position that we own has a lower than market beta, but generally we like to have that in our income portfolio because we know that those companies tend to outperform in the income sector over time. And then obviously the other thing that we look at is we look at some valuation. So after we've gone through our process, we look at valuation to see how it compares, relative to its peers, relative to its growth rate. And then the last thing that we want is we want relative strength. So typically we're not buying as a stock is falling or that it's bottoming. Typically it's already bottomed. The market's recognized what's going on. There's some sort of catalyst that's accelerating the earnings. And that's typically when, we're going to get involved. How do we do this? We basically rank our universe from 1 to 1,000 on every given day. And we know where companies rank both from a fundamental basis. So, how do their earnings rank? How does their valuation rank? We know how it ranks from a technical basis. Is it the strongest technically? Is it the weakest technically? And then we also know where it falls on a combined basis. So when you factor in both the fundamentals and the technical, where does it rank compared to the rest of the universe? This helps us to really figure out who's moving and who's not. And typically it happens, really as a group as a whole. Now, buying is important. Selling, we think, is equally as important. So we do use stop losses in our investment process. And effectively what they do for us is when a stock goes through the stop, at that point in time, then we review it. And so then we're looking for what the catalysts are in the business or what the potential catalysts are in the business. And then we obviously look at the other side is why is it breaking down and should it be sold? And so we try to be very diligent with our process. We look at it from a stop basis. We look at it as it breaks down from a technical basis. And then the last thing that we look at is as it breaks down and drops down through that list. So this list here, as it starts at the top and works its way down the list, it eventually gets to a level where we no longer want to hold it. We'll sell it. And then we look at going into something that's got, faster earnings growth and has better technical profile than the company that we own. So really what we do that we think makes us different is we're looking for higher growth potential companies. Typically, these are under the radar. 10 years ago, we found that a lot more advisors, investors were looking at companies, especially considering, where they worked or what access they had on their online trading platform, as they were able to invest in these smaller companies. As compliance has tightened up over the years, a lot of the big institutional investors, the bank-owned firms, have required their investment professionals to go up cap. And so there's a lot of opportunities that we find that are under the radar. So this really means that we have less competition, and that allows us to have the performance that we do. Now, as I mentioned at the top, we're seeing some changes right now that we think are quite exciting for the markets and also for our portfolio. And so what I wanted to do is just walk you through some of those. Now, this is looking at our asset leadership model, and this is just going out through the year to see, how different things have ranked. And so what we do is we have, 5 different asset classes that we like to rank to figure out who has the strongest relative strength and what we should be looking for. Anytime cash and fixed income ends up in the top 2 spots, that tends to be an environment where the markets don't perform very well. What we like to see is, commodities, domestic equities, and foreign equities in the top. And that's what we've seen. And if you look at, throughout the year, domestic equities has been, pretty strong, either, the one or two spot through the year. You can see that, commodities certainly has worked its way and has stayed fairly high on the list. And right now, cash and fixed income are low. So we think that that's, an ideal place to start with. If we look at some of the, the cross asset analysis here, what we know is that if we look at this chart is copper to gold, and then in the background is the 10-year bond yield. And what you can see is there's a real direct correlation there, that as the 10-year bond yield has been going up, so has the copper to gold ratio. And right now you can see that, a lot of the constituents here in this chart, which is a relative rotation chart, are showing us that they're starting to accelerate again, especially in the commodity sector. So how this works, this is a tool that we use a lot in our firm, is a relative rotation graph. And it effectively is looking at the momentum and rate of change of companies. And there's 4 quadrants. There's the leading quadrant, which is typically when a stock is the strongest. A weakening quadrant, when it can still be strong, but it doesn't have necessarily the market leading relative strength. Lagging, when it tends to be falling behind the rest of the market, and then improving when it's gone and started to see improvement. We like to have the majority of our portfolio in the leading and weakening quadrant, but we like to have part of our portfolio in the lagging, going to improving, going to leading as well. So this is looking at it from the top down perspective and looking at those cross asset analysis. What we actually think the big picture is right now is that we've seen a significant change in the commodity cycle. And, these commodity cycles tend to run, around a decade in length. And you can see that, the last one that really started was around 1999, 2000. This is looking at the ratio of the S&P global index to the Dow Jones. And you can see that it bottomed out back in 1999 and has, had a long period of, up, basically topped out in just before the financial crisis, and then started to peak and rolled over. And we've just seen the same level again that we saw in 1999, or almost identical level. And now we're starting to see it outperform. The momentum's starting to pick up. And we've obviously seen that from the commodity prices. You've seen, oil's up, natural gas is up, cotton's up, you sort of name it for commodities, and it's had a great return. What does that mean? When we look at our global equity market leadership, so we look at international markets to see who has the strongest relative strength, you can see that, Canada is right up in the top of the list, but most importantly is that it's increasing and moving its way up the list. If you look at the top, Saudi Arabia, Russia, those are all, strong commodity countries as well, and they're at the top. If we look over here on the relative rotation graph on the right-hand side, you can see that, Canada, the ETF that represents Canada, has gone from, where earlier this year it was in the leading, then into the weakening, to lagging, and now it's starting to accelerate. And this is kind of the profile of what we like to see is when it's heading on a 45-degree angle to the top of the leading quadrant. That's where Canada is right now. So we think that, Canada is poised to really outperform with commodities, and obviously when the commodities work, our financial services work really well. This again is looking at a ratio of the high beta to low volatility, and you can see here that the line is certainly accelerating and is appreciating. So we're starting to see that pick up again in high beta, which is obviously great for overall market returns if the risk profile is positive. If we look at the TSX internally, what we ended up seeing is that this represents a week in time, and this is looking at the TSX small cap in relation to the TSX. So when the bar is above this zero line, it means that the TSX small cap is outperforming the TSX, and when it's below the line, it's underperforming. You can see that we came into 2021 with the small cap outperforming, and then it gave up relative strength for the majority of the year. It's just recently taken back that relative strength. And so what we're starting to see is that from a sector standpoint, we're starting to see the TSX turning positive, and we're seeing a lot of those sort of smaller cap companies starting to gain relative strength. Same thing if we look at Canada to the US. So this is looking at the TSX small cap versus the Russell 2000. There's been a lot of talk about the Russell 2000 breaking out, but at the same time, the TSX small cap is actually gaining relative strength to what we saw or what we're seeing versus the US. So that's also, really positive. If we look at our macro risk assessment model, so what we do is we look at a number of different relative relationships and rank them, and it comes up with a composite score that goes from -100 to +100. Obviously, if it's -100, we're very defensive with our portfolio. Typically, we're going to have a large amount of cash. If it's 100, we're fully invested, and that's probably the best time to be invested to make capital appreciation. Well, what we can see is that as we've gone through the year, this continues to improve. So if we go back to August, we were in neutral. Now we've seen a number of different factors in that risk assessment model change, and now where we were, in the 50 range right now, which is puts us in that neutral offensive area. So the last thing that I'm going to touch on is seasonality. Obviously, September and October are known for their difficult times. Certainly that was the case with September this year. October has been a fairly strong month so far. I mean, obviously we only have a few trading days left in the year, but November and December tend to be very strong periods of time for the TSX small cap. And that's what this chart represents over the last 5 years. You can see what's happened. So what we're going to do now is I'm going to jump off. We're going to bring the companies on. They're going to talk about what they do, and then I'll come back at the very end, answer some questions, and then also talk about just some stocks that you might want to put on your radar to watch that we're particularly we think have a particularly bright future. So I'll turn it back over to Neil, and he can introduce the next company.